You're live.
I know. We're just gonna retweet this and we'll get going. Hang on a sec. All right. Welcome to Wall Street Beats. Here we go. Repost. I'm Benjamin Bry, joined today by Bob Morris, Charlie Peabody. Let's get it kicked off, Bob. What happened over the weekend? What's going on? Are we still talking about Iran? Are we talking about Iran in 2028? That's the real question.
Yeah, it just continues here, this roller coaster ride. And we were talking pre-show how there's no real clear leadership in Iran now, and there still seem to be different factions vying for control, vying for the microphone as to who's calling the shots over there. And my sense is that the IRGC still holds the upper hand, and they're the ones that instigated these shootings or bombings of these commercial ships last week in the Strait of Hormuz, which basically upended the memorandum of understanding. Where the comment from Marco Rubio this morning was, well, yeah, they obviously violated it, but we're still open to negotiation or trying to reach some sort of an agreement here. And so the U.S. continued the strikes over the weekend. The Strait of Hormuz is clearly in focus right now and trying to keep that open. But over the weekend or last night, oil shot to over $90 a barrel. But on the headlines that they're still open to negotiations, it's back down here almost flat at around $81, $82 a barrel. So, it's these headlines that keep going back and forth are what continue to drive the oil price, obviously. When oil had pulled back to 70 here a little over a week ago, we said that reflected all positive news and the risk was to the upside, and that's what we saw. There are these little events that, not little events, but these occurrences that are upending this MOU. And do they get back to the negotiating table? Do they start to settle back down and try to get to some agreement? I don't know. I think that's going to be touch and go. And like I said, there's no, in my opinion, clear leadership in Iran. And we said last week, when Trump comes out and says, they're dying to reach an agreement. We don't know who it is that's dying to reach an agreement, because clearly there are factions that don't want to go along with the MOU. And clearly I think that's the IRGC that adamantly wants to keep control of the Strait of Hormuz. That's their only real leverage in these negotiations. So, all along we've said we weren't selling any of the names here because of this, because of the uncertainty. And it's hard to say how this does play out. But I think as long as the IRGC has the upper hand, they're going to continue to be disruptive and play this game of stalling, because ultimately they want to have a nuclear weapon and they want to have control of the Strait of Hormuz. So it's still a very, very difficult road ahead. And again, what's been suspended here is the MOU, which again, that's just a memorandum of understanding. It's not, you then have to go to a hard or concrete agreement. So I think we're a long ways off from anything that is firm and complete and hard as far as how the structure of this all ends up playing out. In the meantime, oil prices are going to be volatile, and we're going to stick with the names here. The other thing is sort of shifting gears to natural gas. Natural gas is, and I said last week, beginning to make me nervous. It's been a little bit punkier. Storage levels for natural gas in the U.S. are just slightly below where they were a year ago. And you've got this overhang of this super El Nino, supposedly, that could cool things off. And so, the natural gas names have sort of been punk here. We do have Range Resources and EQT reporting earnings this week. They'll release results after the market close on Tuesday. I do expect a slight beat by EQT and a beat, probably a little bit more than a slight beat by Range Resources. But I think people have gotten accustomed to EQT beating, and while the consensus estimates are for earnings to be at around 41 to 43 cents per share, I'm at 44 cents per share. So I think a slight beat, not as big a beat as they had last quarter, but I think they'll have a slight beat, and they'll have good things to say on the call. And the thing is, we're just battling this natural gas price that on the near month contract is now back below $3 per MMBTU, which is not good, not comforting. And if I look out here, I'm just looking at where we are out in November, December. We're 370. We don't even have a four handle until we get to January, February, not even in February, just in January up a four handle. So, there are concerns around natural gas here, but I still like EQT, EXE. I'm sticking with those names, even though I'm a little bit nervous here, given where natural gas prices are. And expect a good solid quarter out of EQT and also Range, although we don't own Range, but certainly out of EQT, I'm expecting a solid quarter.
Hey, Bob,
All right.
on the natural gas front, as you pointed out, it's been flat on its back and shows no signs of, revival. But um, recently, I've heard people talk about Cheniere LNG, mostly
Mm-hmm.
because it's more diversified and has an export capability. That is there some demand story from overseas that's going to help LNG more than
Yeah, that's
EQT or
there he is. And I think you and I talked about this a couple of months ago, Charlie, and that with what capacity had been knocked out in Qatar from the Iranians shooting missiles at it, ultimately that's going to take a long time to repair and get back online. So ultimately, you have LNG and some of these other companies filling the gap. But there's clearly a demand story for Cheniere, and part of the reason that that stock has done very well. I haven't looked at where it is recently, but there is a demand story because they're an LNG exporter. They're adding LNG export capacity in the U.S., and for that reason, that name is one I'm trying to find here. I'll have to look it up. Um,
it's around 263, but it's been
yeah,
creeping higher for the last 2 weeks, 3 weeks. Um,
yeah. There's not. I don't think there's been any new news on that other
I
than
hear
globally. As far
investors
as the
talking
globe,
about it a lot now, so that's why I'm
yeah, it's one of the
curious.
names you want to play. It's off from its peak. Where do we peaked at? Was it back in April after this whole as part of the whole outbreak? And I think that was around when this capacity part of the capacity in Qatar was taken offline. But there's definitely a thesis here on the long term demand for LNG globally, as long as the global economy remains strong. As there's this sort of uncertainty, at least for the time being, in the Middle East around Iran, this is a name that's going to benefit long term. And again, the long term thesis on natural gas, whether it's here in the US or internationally, is on the demand from these AI data centers, industrial demand growth, and um, power generation. So
Let
there's
me
Just
ask
to make
you.
sure I
clearly
understand, just to make sure
a
I
theme there.
understand, what differentiates LNG from EQT or EXE? Is it the export capabilities that
Yeah,
are?
I mean, yeah, it's EQT and EXE producers. They drill wells, they produce the natural gas. Cheniere doesn't drill wells and produce gas. They just take the gas, they contract for it, and then they export it through or they contract capacity in their export facilities. So their revenue is strictly tied to that LNG export capacity and volume and that demand. So they're just taking the volumes that
Bob, let me
others
ask.
produce.
Bob, let me ask you a question. Why is Comstock such a dog lately? That thing had a nice run at the end of the last year. It's been a dog this year.
It's the natural gas. It ran up on the natural gas euphoria and natural gas prices moving up into the winter. It's very highly leveraged to natural gas. It's one of the higher beta names
Okay.
on natural gas. And with the pullback in natural gas below $3, that's a name that's going to give a lot more back.
Yeah. Wow. Would you buy that here? Do you think that is that someone interesting? It's kind of round trip the whole move.
It's I've never been a big fan of it just because of the leverage and it doesn't pay big dividend. And
Yeah. Yeah.
so
Yeah.
I've stuck more to the steady names like EQT and Expand Energy and
You
Range
don't
and
you don't
Intera.
like to gamble like Jerry Jones? You're not a Jerry Jones guy.
I mean, there's a
Cowboy.
lot of volatility on that name, and you can trade it around. If you can pick the bottom and sell it at the top, there's a lot to be made there. But I take a longer term view with the name, so I know I have good solid fundamentals and with the
Yeah.
dividend, solid balance sheet.
All right. Anything else on the energy front? Otherwise, let's move to banks. It's a banks and tanks day today.
Yeah, I think what I'll do is I'll close the door on earnings season with a few comments
Okay.
since all major banks have finished reporting earnings. We get some of the mid-tier regional banks reporting this week, but all the major banks have finished. And to bottom line, the quarter, it was what you would call a beat and raise quarter. The beat was purely driven by capital markets, trading, and investment banking. Um, And the raise is an extrapolation of more of that to come, particularly on the investment banking side. So, there's a certain amount of enthusiasm coming into the quarter and coming out of the quarter around, the revenue side of the equation, particularly on capital markets. The one comment I would make is while the bulls will point to the backlog of deals as being very robust, Goldman Sachs described their backlog as the highest in the last 5 years and the second highest ever in their history. It still requires an execution backdrop to be able to bring these deals to market. And so that's going to be a function of how markets behave and of the liquidity on the buy side. And the confidence. I mean, you've got SpaceX, I think now still trading below its IPO price. The Kospi index is starting to roll over. So that means SK Hynix doesn't do as well in the aftermarket. So the confidence part of the equation, I think, is starting to at least have some wear and tear to it. Wall Street's never been at a loss for product to sell. So it really comes back to what is the demand for that product and the confidence around that demand. A couple observations I'd make. Let's go to the first slide, Jen, on earnings. This is the earnings per share for the second quarter. The salmon colored column in the middle there shows what the earnings results were. And the one on the right, the other salmon colored column on the right, shows how much they beat consensus expectations. And if you look at the bottom of the page, you see Goldman Sachs and Morgan Stanley had the biggest beats because they're the pure play on capital markets. But then, Citigroup, which I had highlighted, early in June as likely to beat by a bigger margin than the street, had a big beat. M&T, which is my one buy-rated name, I don't have any buy-rated names anymore other than M&T, was a nice beat. And then Truist, which is kind of the dog of the group, also had a nice beat, but the outlook still remains very unattractive there at Truist. So those are sort of the highlights of the quarter. As I said, probably every analyst coming out of this quarter raised their full year expectations. So you've got a fair amount of optimism going into the second half of the year. You can go to the next slide. This is the revenues. On the left-hand side, the salmon color column is the expected revenues. On the column next to that, it was the actual revenues. And way over to the right is, how much the actual revenues beat expectations. The green shows those with the biggest beats, the red with the smallest beats in revenues. And, the two names that didn't beat very, very well by much was JP Morgan and PNC. JP Morgan is interesting because that stock has been a laggard this year. And that's kind of the, what I would call the lead steer of the group. If JP Morgan is not performing well, it tells you something about the group going forward. So I continue to think these beat and raise type numbers are to be sold into. Jen, if you can go to the next slide. This is sort of the capital markets data that was reported in the quarter. The left side is the salmon colored column is the expected capital markets income, and the column next to it is the actual. And on the trading front, you can see trading revenues came in about $10 billion above expectations. So that was the big beat. And if you break down trading to fixed income versus equity, it was the equity beat that was just amazing. It was an $8 billion beat versus expectations. This, by the way, just for historical reference, is the first quarter in the 40 plus years that I've been doing this that equity trading has beat fixed income trading. So to me, it's an indication of what kind of equity bubble we're in, that equity trading is that strong that it's beat fixed income trading for the first time. And that beat on equity trading was 8 billion above expectations. The other thing I would point out is on the investment banking, which is the lower table there. The beat there is about $2.2 billion. That was mostly IPOs where the beat came in. So another indication of how strong the equity markets are. Um, so this is where people are gaining their confidence from, is this trading and underwriting cycle and M&A activity. I will admit, if we continue to see good reception to underwriting and M&A, that's going to spur trading because primary issuance, i.e., IPOs and debt underwriting and M&A, spurs secondary trading activity. But what I would point out to you is that we're starting to see, some rolling over of the Asian markets, and just about every bank that highlighted their strength in trading made note of the fact that most of that strength came out of Asia. So if the Kospi is rolling over here, if the Nikkei is rolling over here, the Shenzhen, Shanghai, or whatever, is starting to show some wear and tear, I don't think you're going to see as strong trading results. And that's important because if you look at the numbers, trading at 47 billion this quarter is 3 times bigger than underwriting revenue. I mean, total investment banking revenues at 13 billion. So if you get a 10% drop in trading revenues, you need a 30 to 40% increase in investment banking revenues just for total capital markets revenues to stay flat. So I'm going to argue that we've seen peak capital markets here in the second quarter. I certainly feel like we'll see peak capital markets revenues here in 2026 as a calendar year. And so the question becomes, what do you want to pay for peak revenues? And I'm not willing to pay up. Let's go to the next slide because this will be the last slide, and then I'll open up to questions. These are some of the key fundamental trends in the quarter. And the one line I want to look at is what we call PPNR in the middle of the page. That's pre-tax, pre-provision net revenues. Year over year, if you go all the way to the right-hand column, came in up 20.7%. That was better than the 16 plus percent that I had been expecting. So again, it was all driven by capital markets. And you can see that if you go to the top of the page and look at fee income, which is the second line down from the top of the page, came in up 20%, and we've been looking at mid-teens expectation. So it all comes down to capital markets and your biases. At the end of the day, I think the capital markets and the AI, data center chip trade is all one big trade. If the CapEx spending continues to be robust, you're going to generate a lot of loan growth. You're going to generate a lot of debt issuance. You're going to generate IPOs, M&A activity. So to me, it's all one big trade. And so I will turn it over to Ben to tell me whether the CapEx AI cycle is going to continue or not.
Yeah, I mean, let's see if they keep on keeping on. It's a weird situation because it's like, I think, Charlie, the banks seem to be a derivative play of it, between the capex driving the economy and the markets. Driving the market then drives spending, drives deal flow, as you just talked about. And so, it's strange to see the banks so strong where all the shadow banks are really kind of on their butt, right? And then, you have this capital market cycle and they're clearly a beneficiary. Because I am under the impression that, let's just say this thing rolls, right? Like, okay, so it's coming out more and more. Alex Karp from Palantir comes out, then Chamath comes out. It sounds like guys are turning on Sam. Over the weekend, we got this Kimi K3 model, which is like, 70% cheaper than the Fable model out of Anthropic, but, it's pretty damn good. And I think the market's waking up to these LLMs are commodities and that there's a whole lot more to actually getting ROI. Like what companies are getting ROI is still elusive for most of them. So let's just say it rolls over. I would think that then that will drive a recession because all the rest of the stuff that Charlie, you and I have talked about for a while, housing, kind of a mediocre consumer, blah, 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 will only be accentuated. And then if rates go down, what do you think that does to the banks? If we get rates down, let's say bull steepener, what do you think happens? What is the impact on the banks? Forget about the credit because we both have the view that credit will be tougher for them. But what do you think just about the rate side?
Yeah, I mean, if you're talking about the short rates coming down faster than long rates, i.e. the bull steepener that you referred to, as that develops, it's actually good for banks as it develops. But then if you reach a level, such a low level where they can't lower their deposit costs anymore, it catches up with them, and then you start to get NIM compression. But the initial process will expand margins. And if you're talking about a deflationary environment, that's important because that then starts to weigh on credit quality. In other words, the collateral values that you thought you had against your loans aren't worth what they're worth. And we've seen that already. We've seen that in software. We've seen that in used cars after the COVID collapse. We've seen that, in some of the healthcare services that are being, replaced by AI. So if we get into a deflationary environment that causes short rates to go down, that's going to impinge on a lot of the credit numbers as well. The initial effects will probably be
kind of in that
bid up.
Yeah. So, I think we're keeping an eye out on it. I think we've had a pretty good correction. I mean, the Kospi's down 25, 30%. The Neo clouds are down 50. Oracle's down 50. Oracle got downgraded. So I think it's been SpaceX is down 50. So, it's been a fairly robust rollover since June. So I think as we have earnings come through, we want to hear what people are saying about returns, what they're saying about spend. And then, we're going to see what guys say about their excess compute, specifically Meta, SpaceX. But it's an interesting time. We'll see how it plays out. It's the middle of the summer and it's earnings season. So it's always a funny time of the year where it's like, people are working, but they're not working, but the markets are still humming along. So we'll see. You guys got anything else? Otherwise, let's get out of here.
Nope, I'm done.
All right. Well, this is a good Monday show to kick off the week. I am Ben Bry. That's Bob Morris. That's Charlie Peabody. We're Wall Street Beats. We'll be back at you tomorrow. Have a great day.
Thanks, Ben. Thanks, Bob.
All right.
Thanks, Ben.